When a family inheritance includes illiquid assets such as property, business shares, or long-term investments, inheritance tax becomes a liquidity problem. The tax is calculated on the total estate value, but the liability must often be paid before the assets can be fully transferred. This creates a timing gap. Your beneficiaries may inherit property, investment portfolios, or private business shares, but the tax bill is immediate while the assets are not always easily convertible to cash. In practical terms, this means families sometimes face pressure to sell assets quickly. Property may be sold below market value. Investment portfolios may be liquidated at the wrong time. Business interests may need to be partially transferred or financed simply to settle the tax liability. The challenge is funding the inheritance tax when assets are not immediately liquid. My name is Shiraz Wahid and I'm the co-founder at Liquidity Wealth. And in this video, I'm going to explain how life insurance is commonly used to create liquidity for UK inheritance tax, how it is structured properly, and where it sits within the general cross-border wealth framework. UK inheritance tax is charged on the value of an individual's estate at the time of death. For individuals who are UK domiciled, this exposure applies to worldwide assets. For non-domiciled individuals, UK situs assets such as the UK property or certain UK investments may still fall within the scope. Tax rate is typically up to 40% on amount above available allowances, although the final outcome depends on the domicile, ownership structure, and reliefs. The key issue is that inheritance tax is assessed on value, not liquidity. A property portfolio may be worth several million pounds but may not generate immediate cash. Private company shares may carry significant value but cannot be easily sold. Even listed investments may be subject to market timing considerations, especially during volatile periods. This creates a mismatch because the tax authority expects payments within a defined period, while the estate may require time to organize transfers, valuation, or financing. In some cases, executor must negotiate a staged payment. In other cases, assets are sold to fund the liability. Both outcomes reduce control over how wealth transitions to the next generation. Families often focus on reducing inheritance tax exposure through planning, but that is one part of the conversation. The second part is funding the liability in a controlled way so assets do not need to be sold unexpectedly. Life insurance in the context of inheritance tax planning is not primarily an investment. It is a liquidity tool. The purpose is to create a defined pool of cash that becomes available when the tax liability arises. Instead of selling assets, insurance proceeds can be used to settle the tax bill. This approach does not eliminate inheritance tax. It helps to fund it. The distinction is important. The state still pays the tax, but the payment is made using a pre-arranged liquidity through life insurance rather than forced asset sale. For example, if an estate is expected to face £2 million of inheritance tax liability, a life insurance policy may be arranged for that amount. Upon death, policy pays out. Proceeds are then used to cover the tax, allowing underlying assets to transfer intact. The outcome is continuity. Properties remain within family. Investment portfolios are not disrupted. Business ownerships remain stable. The structure provides certainty around how liability will be funded. This is why life insurance is used often alongside succession structures rather than as a standalone solution. If a life insurance policy is held in your personal name, the proceeds may form part of the estate. That creates a circular issue. The insurance payout that is intended to fund inheritance tax may itself become subject to inheritance tax. To avoid this issue, insurance policies are commonly written into a trust. Trust becomes the legal owner and beneficiary of the policy. When the insured individual passes away, proceeds are paid directly to the trust rather than to the state. This structure keeps the payout outside of the taxable state, subject to proper implementation. The trustee can then use these funds to lend money to the state to pay the tax liability or distribute fund according to the trust terms. This arrangement also helps with timing. Insurance payouts to the trust can often be released faster than the estate assets that must pass through probate. The trustee therefore have liquidity available when the tax becomes due. Control and governance also remains important. The trust terms define how the funds are used, who the beneficiaries are, and who acts as the trustee. This is why insurance element is usually designed together with the wider estate plan. For international British families, the position becomes more complex. You may live outside the UK, but you still hold UK property, UK investments, or business interest. These assets remain within within the UK inheritance tax scope even if your personal tax residency changes. This means that the liquidity problem still exists. A UK property portfolio owned personally may still attract inheritance tax. If the beneficiaries are outside the UK, the funding challenge can become more complicated due to banking, currency, and timing considerations. Life insurance can be structured to match this exposure. The policy amount is aligned with the estimated UK inheritance tax liability. The ownership structure is coordinated with domicile status and asset holding structures. The trust holding the policy may also sit within the broader international framework. This is particularly relevant where assets are not easily divisible. A single UK property or concentrated investment holding may not be suitable for partial liquidation. Insurance allows the tax to be paid without disturbing the ownership. It also helps when beneficiaries are based in different jurisdictions. The trustees can settle the liability centrally rather than requiring beneficiaries to coordinate funding individually. The cost of life insurance depends on age, health, policy type, and coverage amount. Inheritance tax policies are often structured as whole life coverage rather than fixed term policies. The objective is to ensure that the policy remains in place wherever the liability arises. Premiums may be funded personally or through planned gifting strategies. In some cases, premiums are paid from surplus income, and in other situations, families combine insurance with trust funding arrangements. It is also important to review assumptions regularly. Asset values may change, property values may increase, investment portfolios may expand. The expected inheritance tax liability therefore evolves over time. The insurance coverage should be reviewed periodically to ensure that it still matches projected exposure. Medical underwriting is another factor. Policies are generally easier to arrange earlier, and the cost increases with age. For example, individuals in their 40s often find premium relatively manageable. In their 50s, premium increase but remains practical for larger estates. But by the 60s, underwriting becomes stricter and cost rises more significantly. This is why insurance is often considered as part of early estate planning rather than a late adjustment. Banking and jurisdiction also matter. The insurance company, the policy jurisdiction, and trust structure should align with the overall estate planning framework. This avoids complications when claims are processed. Life insurance is typically one component within a broader inheritance tax planning. Some families reduce exposure through ownership restructuring. Others use trusts, foundations, or holding companies to manage succession and control. These approaches address ownership and governance. And then insurance addresses liquidity. It ensures that regardless of how assets are structured, the tax liability can be funded without disruption. In many cases, both elements are used together. A structure may define how assets pass to beneficiaries, while insurance ensures the transition happens smoothly. This is particularly relevant for cross-border families where probate, valuation, and asset transfer timelines may vary. Ultimately, inheritance tax planning involves three paths: understanding the exposure, structuring the ownership appropriately, and ensuring liquidity exists to fund that liability. Life insurance primarily addresses the third element. So if you want our help and would like to explore whether these structures and strategies fits your situation, you can request a personalized asset protection plan by clicking the link in the description below. That's it for today, and I will see you in the next video.